Yeah, it's definitely down because it's losing, but it's just noise. There's no information. In terms of engineering signal theory, it's entropy. There's no information. It's just noisy data, no signal. As at there, it's above 0.5. There was a definite trend for a while, and this is how useful this thing is. Now, maybe when it falls to there, you can say, well, it's not really a turning point. But once it hits past the 2 standard deviation, which coincidentally, it's just a coincidence that it's there. It's not always there, because I've done this on a number of different stocks. Once it's below the 0.5 line and it's falling into randomness, it's time to take stock and risk manage, sell, or do whatever, or hold out, depending on what you believe. But it's a clear signal, and it's not like technical analysis. It's not nonsense. It's real. It's not we're following zigzags and we're guessing and we're hyperbolating or whatever. I don't know. It's real. It's statistical. It's there for all to see. It may be a bit hard to understand for some, but it's real. And also I've added, now this is once again something that's really simple and it's way overlooked. Now there is a definite correlation that when a large number of shares are sold, that the share price is generally dropping as a rule. There is more volume activity when share prices drop than when they rise. As you can see, this shows return on that axis there, and I've overwritten on another axis the volume normalised between 0 and 1. And you can see that when it's zigzagging around the prices, the return's zigzagging around, not much around 0, just up and down a bit, as it does. There's not much volume. But when it really drops it goes up and then it really drops, you can see it spikes up. When it drops high, it spikes. It's an indicator. It's real. It's not technical bullshit. And actually, it also spikes sometimes, but generally not as high when it goes up. But see, there was big movement when it suddenly went up there. Now, you could do an event study to see what was going on. I'm pretty sure that I know what that was. That was the government stimulus money, because that's when my friend bought this share. That's why I got interested. It's Australian stock, Qantas Airlines, Australia's national airlines. The government bailed it out with the not the GFC, the COVID crisis. And you can see there's a huge influx of money when they heard the subsidy was on. And my friend bought it there. So he was, even though compared to it was just in profit last year, the end of last year. This year it traded all at a loss, but he made it, because he bought there and sold about there or there, he made a profit. So he was okay. But on a 1 year basis, you can see it's a downtrend and it's making a loss. But, you can see how events affect shares. Like government pumping quantitative easing into an airline. you can make money, and that's what these things show. If you imagine that looking at wiggly lines on a chart without any correlation to reality, psychology, well, if you think you can read anything from human psychology, if you've studied psychological research, you know it's mostly mumbo jumbo. Everyone contradicts each other. So I don't take psychology too seriously. I take facts and correlation and real things, and not technical indicators. Cumulative returns down, but he made money because he bought down there and he sold here or somewhere. That's the thing about it. If he bought last year, he would have been in dire straits. But you can see it zigzags around, and like the volume as it dropped again there. See where the precipitous drop was there? And the turning point on the chart, where it's going from a definite trend, the stimulus is on, the money's going up and up and up, then drops a bit, then the money's in, it's up, it's up, it's up. Then the government, I think, started cutting subsidies, and it dropped like a ton of bricks. And you can see the volume of selling spiking and the return dropping for that day. Then it went up again, then it dropped down again. Such is shares. It's not a hard and fast rule, but it's a pretty accurate rule. Hope that's been helpful, and while I'm on it, I'll just show another share, because I'm an options trader and futures trader. I don't like shares much myself. They cost too much, you don't make good returns, and basically they're dead wood. You can't buy, sell, you can't hedge. There's not much you can do with shares, unless you got absolutely millions of dollars or hundreds of thousands at least. Anyway, we'll go to, where's this other spreadsheet? This one. This is based on Espen Haig's wonderful formulas. I'm going to show more great spreadsheets that have accumulated over the years, which I've modified. Now, I was doing a delta hedge. I'm still doing a delta hedge. It ends in January or February 2020. If I make a profit before then, I'll close out, but it's hovering around break even, so I'll probably have to see it out till the close. But at this day, I haven't updated the prices. Strike price was 25, asset price was 27, 1% risk-free rate, it's approximate. Now, I couldn't actually get the volatility skew. I do subscribe to a service which provides it, and I can calculate it myself, but Fifth Bancorp is not a frequently traded share. It's liquid, but it's not. It doesn't have a big spread of options to get a good, reliable volatility. So it's better to leave it just 0.01% as a rough guess, which I think that was, or naught. Now, I don't know what the price is today. It was accurate at the time. It's estimating that today it should be worth 13.26, but like the asset price could have changed since then, and volatility could have changed. I'm not sure. And I won't go into the details of these. It's too complicated to explain here, because this is just a quick video. I'll make a more thorough one later on. This is an interesting one of Espen Haig's too. It's a really beautiful spreadsheet. He has like the complete Kama Sutra of your Greeks. Any Greek you want, he's got them all there. And this is Merton's dividend adjusted European option pricing. It's pretty good. It's pretty accurate. If you get a good estimate of implied volatility, you'll get a good estimate of the share price. If you use historical volatility and you've got arbitrage, or GARCH as a volatility measure, you're a bigger fool than I can believe. Or the Black-Scholes model only works in reverse. It's the right model for the wrong reason. If you expect the price that you get from putting in all the parameters that they say, you will never get the right price. You have to work backwards. You have to estimate the implied volatility, which is down here, bisection method and Newton-Raphson method. The implied volatility was 35.4%. The market price was 32 cents. And let's see, we applied that in there. with the dividend was 1.08, and we got 34, so it's pretty close. So the option price is actually undervalued rather than overvalued, which is an unusual thing because it's a put. Puts generally are overvalued, especially once they're further out towards out of the money. So generally the market must be bullish, I would say. Maybe the calls, maybe there's a contango, I don't know. Haven't looked into it for a few days. I've looked at the position, it's safe, but I haven't done a lot of research. But anyway, you can see this is great. Great chart, fantastic. That is the delta. It's a put. A short put, actually. I mean, it goes into such detail. Like, it's a short put and it shows you the delta over the range of how long? I think it's start point 10, from 10 days to 365 days. So it goes the whole year, the delta, the range. It's really nice. We can change, we'll change to, or what do we change it to? Can we get the value? It doesn't look like we can get the price. We can get gamma. Gamma's, I think there's a gamma's, Vega's a nice one. That's the volatility. I'm not so sure about speed. I think that's a rate of change of gamma. Let's see, I have to update this, or is it calculating? It is calculating, I think. I usually, with all these sort of spreadsheets, you want to turn off automatic calculation. This is automatic calculation. When you've got lots of tables, it can really slow your machine up. Even this is an i7 processor 8th generation. It can still really, lots of these numerical calculations in tables can really slow your machine up. Although that wasn't too bad. So nice graph, the gamma there. You can see that it's a fair chance, 80%, that I'm going to make my money out of this. On the put side, I don't know where the call side is. I think the call side was 29, so I think that's fairly out of the money too. Or as a strangle. I have another spreadsheet which shows both sides, but that's for another time. I better sign off because this is getting a bit long. I don't know, I don't think it's got the Black Skulls price, is it? Delta, elasticity, gamma. We'll have a quick look at gamma. Calculating, yeah. No. So, that was the gamma, was it? Was it? Must. Oh no, here we go. Yeah, it must have been the gamma. Oh. I thought it was a Vega. Huh. We'll have a look at the Vega anyway. I've got some other formulas down the bottom. I'll just show them quickly before we go. I thought, did we look at the Vega? Vega. Huh. I better press F9 to see if it's on. Calculate. Doesn't seem to be recalculating. Oh, could be just similar graph, couldn't it? Yeah. Yeah, it is Vega now. It's definitely different. Anyway, we'll move on down here. I've got decay over time. Now that's a table that changes when all the data up above changes all the time. That's the time periods, 0.05, 0.06, 0.07, 0.891. That's number of days divided by 365. And that's the price estimate over the time. That's the decay. Here's just a little thing I can muck around with to see if I change the price by so many percent, I can see how it affects my margin, because margin is a big problem in small accounts. You can be in a position where you're financially going to make money, but you may not, because of the margin, be able to trade out of the position. So you've really got to watch, when you haven't got a lot of cash, you've got to watch your margin. So yeah, I calculate margin. You can see it's only a very cheap $27 stock. It's expensive for me, but it's cheap really. There's no way I can do a strangle on Google or something for $500 or $1,000 or whatever. I just don't have that sort of capital. The most my range is $30 to about $10 for strangles. I can do short put spreads on SPY and QQQ and IWM, that sort of thing. But I can't do strangles. Can't naked right, haven't got the cash. And I think that's it. There's nothing much here, just that's where I downloaded the dividend price. Nothing here. There's more to show in the future. This is just a thing like a date picker. There are all formulas to select dates for mucking around, for getting data from Market XLS, which I'll talk about more later. It's a data download service. I'm not going to advertise it here. We'll talk about it at other place. That's one of those built-in free date pickers you can get from the add-ins at Developer. Add-ins there. It's pretty good. There used to be another one, but it died. Anyway, but we got this. They used to also have one built in before Office 365, and I haven't been able to use that one. That's gone too. But this is the only one that I can use now. It's okay. Anyway, enough talking. I'll sign off, and I'll get these spreadsheets together in a better way, and I'll get some decent monologue together of help to people trading. Just to show you what you can do. There is things you can really do out there to help yourself. You don't need to rely on nonsense and gibberish. And just get money one day and hand it back the next day. Life's not meant to be stupid. Anyway, I'll sign off.